Ladies and gentlemen, dear members and colleagues, on behalf of the Franco-German Office for the Energy Transition, I bid you a good morning. We are very pleased to have so many of you with us today for our first webinar after the summer break, Beyond the Hype, PPAs for Industry and Hydrogen, that we bring to you in cooperation with Enervis Energy Advisors. Corporate PPAs have been one of the hot topics in France and in Germany for the last few years, and they were touted as the coming format of doing business with electric renewables in the future until spring 2020, when COVID-19 hit power markets and they broke down. With the spot price as a natural benchmark, the first PPAs format suddenly looked overpriced and not flexible enough to cope with market volatility. However, things are moving quicker than ever in the energy markets. 1 year ago, in September, we were told that things were pretty much back to normal. And the day-ahead price for baseload in Germany was at 50 euro per megawatt hour. Last week, it peaked at 134. The situation in France is even more impressive, where the hike went from 54 to 166 euros in 1 year. And by this simple observation, we can grasp the potential impact on the evolution of PPAs. But there is much more to take into account than simple market curves if we want to understand the pros and cons of PPAs. And it is a great pleasure for me to welcome Julius Ecke from Enervis Energy Analysts, who will share his observations and interpretations with us. Some of you might remember him from a power market webinar we did together last year, and it is great to have you with us today, Julius. Now, before I'll pass over to you, some technical announcements. We are aware of the fact that this is an issue that stirs a lot of interest and that you might have quite a few questions for our speaker. You can submit them via the chat function in the webinar cockpit. We will do our best to keep at least 20 minutes for a Q&A session at the end of the webinar, but that might not be enough to answer all of them. I'd like to apologize for this eventuality straight away. Julius agreed that we send the remaining questions after the end of the webinar, so he might reply to you directly. Also, this session is being recorded. The slides will soon be available on our website, and you will be able to access the video in the member section of our website. A big thank you to Enervis for agreeing to this. You shall receive a mail notifying you once the files are available for you to download. If you should experience difficulties with the sound or the image, my advice for you would be to shut down the webinar plugin and to relaunch it by clicking the link in the notification mail you received this morning. One last thing before we start. At the end of the webinar, you will be asked to participate in a quick questionnaire. It's just 5 questions. You can skip that, but if you participate, you will help us to improve our offer. So in that way, it is for your own good. Very well. That's all from my side for now. Julius, please take over. Have a great webinar, everyone, and we speak to you later. I see. Yes, now we can go.
Yeah, dear ladies and gentlemen, Sven Rösner, thanks a lot for the introduction, and I'm happy to have the opportunity to present today on the topic of green PPAs for industry and hydrogen. Yeah, so forward please. I speak here today representing Enervis. We are a model-based strategy consultancy focused on energy markets. We have a pretty widespread operation in most core European markets with a broad range of topics. Forward, please. And this slide shows you a rough overview of our consultancy fields. We work on a broad range of topics, ranging from power market modeling to auction modeling and policy studies. Regarding the topic that brings us here today, I have, for example, worked personally on signing one of the, at its time, largest corporate PPAs. So this is part of the experience I bring to this presentation. We worked on signing a 100 megawatt offshore PPA Covestro with Ørsted a few years ago. I think it was one of the earliest in the European market. Enervis also works a lot on hydrogen. At the moment, we work on, well, two major, among the bigger ones, hydrogen production projects. And I'm happy to bring also a bit of anecdote from these kind of projects to the presentation today. So whenever you need model-based advice on strategic energy-related questions, always happy to enter a conversation. Just give us a call. Forward. Against that backdrop, I want to discuss the following agenda today. So first, I want to give a quick introduction into the policy framework. Then we will kind of move from green power, first main topic today, to green power specifically for hydrogen production as a second main topic, and then sum it up in the conclusions. Forward, please. So let's jump into the first topic. Forward. Hydrogen can be a major enabler of the energy transition, especially in sectors hard to decarbonize. I think this is by now pretty much shared established knowledge. I want to illustrate this a bit with two graphs. On the left, you see a typical decarbonization target, in this case a German one, showing historic CO2 emissions and projected targets, and the gray dots here being the most recent ones. And I think this pretty clearly illustrates the challenge ahead of us to, for example, come down to 65% emission reduction in 2030 and more or less decarbonize by 2050. So there's quite a challenge. And on the right, you see the role that hydrogen can play in such a scenario. The graph shows you here from a recent pretty central German study from the Ministry of Economic Affairs and Energy, electrolyzers produced hydrogen in the German zone. And you see two trajectories kind of showing the range of uncertainty in regards to the role that hydrogen can play in the deep decarbonization. The lower of the two shows you hydrogen production in a scenario where there's actually relatively little need for hydrogen, mostly in industry and a bit in transportation and deep decarbonization of the power sector, so security of supply. The higher of the two trajectories shows you a world in which hydrogen also helps to decarbonize the general heating sector. And you can see, well, in 2050, we have a pretty, well, widespread range here, roughly 250 terawatt hours to almost 700 terawatt hours, but still even the lower one being quite substantial. And in 2030, I guess the same holds true. The range here is 20 to 45 terawatt hours hydrogen production in the German zone. That sounds like a little, but as you probably most of you know, is quite a bit. And especially if you translate this in regards to how much green carbon neutral energy would you actually need, electricity, to then produce so much hydrogen. So decarbonization needs hydrogen. We don't precisely know how much, but quite a bit. And this needs quite some terawatt hours and terawatt hours of decarbonized power. This defines a bit of a challenge from a sourcing point of view. Forward, please. But luckily, there is a bit of a more solid political framework in place by now and further developing. We now have a set of strategies that have been published, foreseeing quite impressive expansion of electrolyzer capacities. On the left, you see some core points from the European, French, and German hydrogen strategy. And as you can see, this implies quite impressive gigawatts of installed capacities by 2030 and a corresponding investment volume. Also quite impressive numbers, but more and more we're moving beyond the strategies and also seeing more robust political framework. On the right, you see sketched out some of the more relevant ones, but as you know, hydrogen governance is very much also a national topic, so it depends a lot from country to country. Just some quick points. To meet the European Fit for 55 targets, there is a relevant role of hydrogen in the transportation sector. This already has been sketched out in the RED II before. One major point we're still waiting for is the RED II Delegated Act, which ought to establish conditions, criteria for what actually defines green hydrogen. This is a very important piece of legislation. We're still waiting for it. Should be available hopefully by end of 2021. And in the general Fit for 55 context, there is a lot more of generally favorable regulation for green hydrogen production coming. So now we have seen that we need terawatt hours and terawatt hours of green hydrogen and green power to produce this green hydrogen. So let's look a bit at the market that ought to produce those terawatt hours. Forward, please. So we're going to look at the market for green hydrogen first in two steps. First, look at the general market trends, and then we're going to dive a bit deeper into the nature of the PPA. Let's start a bit with the relatively recent history. This slide shows you capture prices of central renewable generation technologies in France and Germany, as well as average generation cost LCOE. So on the left, you see those average wholesale market revenues, also called capture prices, of an average renewable PV profile in France and Germany. So for example, in France in 2018, the average capture price was roughly 51 euro, and then in 2020 dropping to roughly 30 euro, right? So this is an indicator of how much average generation profile is worth in the specific market zone. From 2016 up to 2020 in the two countries and for the two technologies. The range you see indicated in light colors in the back is an indicator of average generation costs. So practically as a means of comparison, if average wholesale revenues are above or in the range of costs, then you have a bit of a business case. As a rough assessment, if average revenues capture prices are below costs, then you generally don't have a business case. And what we can see almost about over all technologies, that in the last calendar year, 2020, based on the spot prices at least, there wasn't a super strong drive of market-based renewable expansion, right? So capture prices had dropped, generally at least below costs. So that's an indicator that in that specific year, there wasn't a whole lot of additional revenue. But as you know, this is only history, right? 2016 to 2020, you can see here. And now we want to look forward a bit and see what the recent developments have been. Forward, please. So this slide shows you the most central developments on the markets over the last 12 months. So this is base prices, German CO2 prices and gas prices, and the different lines indicate always future years, right? So delivery in the next year up to the next 8 years in the case of CO2. And what you can clearly see is that, let's start with the middle maybe, CO2 prices have exploded, right? So you see in this, we were easily below 30 in the last 12 months, and now we are up to the highest until I think something like mid-September, 70 euro per ton. On the right, you see the also pretty impressive development of gas prices, especially for the next year. Well, practically also jumping in two records. And out of this, of course, together with some other effects, drive power prices. So if you look as an indicator of general power prices at the German notations, you see the very impressive development and with heights of almost 100 euro per megawatt hour. So power prices also have been going, well, let's say crazy, pulling up PPA prices and signaling to some extent, let's say, golden future to the providers of green energy. All of this against the development of decreasing renewable costs. Next, please. This slide shows you a compilation of clearing prices of the most central European markets and their renewable auctions. So each dot represents a cleared renewable auction in a specific country for a specific technology. And as you can see, this is development from 2015 to roughly now. Renewable energy costs have been dropping. Not all of them have been dropping below a certain level, right? We see a certain convergence, maybe one can see, but versus historical prices, right? This indicates a very impressive reduction of overall renewable generation costs. Also, maybe a quick note on the right side, September 21, you see a zero for German offshore. As you probably have seen in the news, again, we have seen 0-cent bids into the German offshore auctions. And what does it mean? Well, this means that investors, project developers are very confident in the future of power prices and in the future of PPA market, confident enough so that they think they can market their offshore volumes at a price above costs via the market and PPAs, right? So they don't need any subsidies. So this also is an indicator of confidence in the PPA market. And this general story of, as you have seen, increasing power prices, especially most recently, and decreasing costs, defines an increase or motivates an increasing activity in PPA deals. Next. This slide, for example, shows you an overview of the most central providers and off-takers in the EU of PPAs. So this is different market players and their announced or realized PPA pipeline in megawatt. The different colors indicate different technologies. On the left, you see PPA providers. On the right, you see PPA off-takers. Also, maybe noteworthy that market players, of course, can be providers and off-takers at the same time, right? Because, well, utilities oftentimes do both. Quite recently and accelerating, we have seen quite an interest from the market when it comes to PPAs. And I think this is a bit of a game changer versus a few years ago. The interest is widely spread also among off-takers. For example, we have seen quite an interest now in chemical companies hitting the market, but not only that, of course, also project developers and utilities have a strong interest in PPAs. And I think this mix clearly is a sign that we will see more and more PPA activity over the next few months and years, especially supported by a strong, stable power market outlook. But also, please note that the PPAs behind this compilation are still quite diverse, notwithstanding initiatives to develop and establish standard PPAs. Next. Let's take that opportunity and have a quick glimpse into the parameters of PPA design and procurement. This slide shows you the most central parameters kind of in the rows of this matrix and examples of how the parameters could be realized in the right example column. So overall, this gives you an overview of typical degrees of freedom. Let's quickly go through it from the top to the bottom. Well, the off-taker of a PPA can of course be different. There are utility PPAs and corporate PPAs. Most recently, we have also seen increasing interest in the corporate PPA market. Then the type of the PPA can be different. Physical or financial PPAs with physical also PPAs, including also the delivery of the underlying power. One thing I always want to highlight is that there are different procurement procedures, tender procedures in the market. There are auctions being conducted by off-takers, which in a very transparent multi-round auction design, for example, procure a large amount of green power over different regions. An important example of that is Google, and by their own assessment, they're quite happy with the outcomes of those auctions. There are also tenders being conducted. For example, DB, that's a German train network operator, or the train system operator. They're conducting semi-standardized tenders for renewable auctions. And there are still different negotiation procedures, them being open or being exclusive, right? So there's still a diverse set of different procurement procedures in the market. Then there's the question of selection criteria. There is, of course, lowest price. Then you can do things like adjusting for the capture price, the value of different generation technologies, because, well, price alone is not relevant if you have different value at wholesale level of generation technologies being part of the procurement mix, wind versus PV, for example, and you can also select PPA providers among a diverse set of other factors. For example, credit risk. PPA pricing is still diverse, but with a strong focus on fixed price, meaning that over prolonged periods of time, the euro per megawatt hour price of the PPA is fixed, be it in nominal or real terms. Then we have indexation with a minor role, I would say, and you could come up with many mixed versions, being floor or collar versions. The delivery of the PPA can be pay as produced or pay as nominated. Both we see, and we're going to come back to the pay as produced point a bit later in the presentation. As you can see, the degrees of freedom in PPA design are still quite large. The PPAs are diverse. I personally think I have seen most of those in practice being in a contract or in a tender. But this also means that among all those degrees of freedom, it's important for an off-taker, and today we argue a bit from off-taker point of view, to really think through what kind of PPA design suits the company and your risk interest. As a side note, for example, a company selling their product on a commodity spot market might be interested in a different PPA risk structuring than a company selling versus fixed price, right? And this is especially important for an electrolyzer. If an electrolyzer, let's say, as a specific company signs a PPA, they really should think through what their risk position is. What actually are they selling their hydrogen for? And this is important because this has implications for the risks they should be willing to take in their PPA for procuring green power. So this is important to take into consideration when picking a tender procedure as well as a preferred PPA design. Next, let's look a bit into how these contracts are actually priced. Next. There are typical two ways to look at the price of PPAs, in a way strongly correlated, and this slide shows you an overview of those two variations in what we call a PPA cascade. The first version to look at the PPA price is, well, to look at the PPA price. This you see on the right side of the slide. You go to the market, you do a tender or a request for information procedure and get prices for the PPA you are interested in. This is obviously an important indicator of, well, PPA price. The second way to look at the PPA price is to look at the value of the PPA. And the value is mostly derived from the value of its components, most noticeably power. Let's quickly go through it. So what do you do for this? Well, this slide shows you this kind of, the most relevant elements of a PPA value in a schematic way in euro per megawatt hour. So the most relevant point of the PPA value based on opportunity pricing is, of course, the value of power. Let's say you look at the forecast, the projection of base prices in general, and more importantly, of capture prices, which are the average revenue that a specific underlying generation profile of a PPA can capture, which is mostly under wholesale base to a certain extent. This gives you the market value of a general technology. This you can correct, for example, by taking location and technology specific factors into consideration. It's always important to note that some technologies and some regions within a country perform below average when it comes to the capture price they can realize, especially if they're located in a region where a lot of the general technology profile is located. Well, then you get a specific capture price for location and technology. This you can adjust for the value of greenness, guarantees of origin, balancing costs, effects of inflation, to get an assessment of the capture price, the value of the PPA. And then, this is the second from the right, the delta. If you compare the prices you're getting from the market and the value you have derived based on power market projections, you can get an important criterion for the merit of the PPA, right? So value versus price, if you compare that, you see if you have a business case. And the value, the merit can be positive or negative, right? That very much depends on your power market outlook. Sometimes power prices indicate the value of PPA above the price you're getting quoted, sometimes below. That depends on power price expectation and, of course, how good the PPA offers you are getting. We're going to quickly have a look at both of those perspectives next, beginning with the price. Here you see as an example typical quoting prices as a range for PV PPAs and onshore PPAs in Germany, though, right? So for PV, you see a range of 45 to 55 euro per megawatt hours being quoted. This is nominal for a pay-as-produced PPA, a new asset. And onshore, you see prices being quoted maybe in the range of 65 to 85 euro per megawatt hour for new onshore in the German zone. Again, pay-as-produced. Well, this is new onshore. This means this is units that theoretically could go into EEG auctions. This clearly explains why their bidding prices are in general quite a bit lower, quite a bit higher. Of course, with post-subsidy assets, post-EEG assets, you can go lower. But as you can see, the market quotes you at the moment quite a wide range of prices. So this clearly indicates that it's important to do a profound, solid tender procedure to get the best prices for the PPA you want to procure. Also, you have seen the power market development I've shown before. This also drives up PPA prices at the moment. So if you want to make a good deal, it could be important to move fast or at least have a clear strategy on how to move. Next. The second perspective I said to look at the PPA is the value derived from power market prices, from power market revenues. I brought an example from a, well, not super recent, but quite recent forecast that Enervis does on a regular basis. So this is the development of capture prices and base prices in the German bidding zone in euro per megawatt hour, the upper curve being base prices and the lower curves being the capture prices. This is just an example to show how those prices can look, right? And one important thing to note is that capture prices can actually go down in the future a bit. Why is that? Well, some forecasters still forecast kind of skyrocketing developments of capture prices in the future. But it's important to note that this only can hold true if renewable energy supply is not flexible, which we don't believe. More precisely, the topic we are discussing here and today, PPAs, clearly shows that the PPA market is flexible to some extent. Power prices being high drives up the supply at decreasing renewable costs, and this additional supply can lead to at least stabilizing or decreasing capture prices. This makes buying renewable energy in a PPA, well, a strategic question. The right kind of PPA can easily impact tens of millions of procurement costs. So it's an important decision to make, and important not to jeopardize the competitiveness of the specific off-taking company. Next. If you are interested in such topics, Enervis prepares long-term power market forecasts in most European markets. Yeah, so happy to end the conversation on that. Next. So now let's have a look at what to do with the green power that we in this illustration have procured via PPAs. Next. Well, clearly, let's produce hydrogen with it. This map shows you an overview of the planned electrolyzers in Germany. And so the size of the bubbles indicates the installed capacity. And we took the liberty to highlight some. Maybe first thing to note is that there's still quite a range of sizes, with the bigger ones being up to a few hundred megawatts in the pipeline. So an impressive upscaling of electrolyzers, and those electrolyzers need green power, decarbonized power to function and to produce green hydrogen as a, well, sought for product. Among the major electrolyzers, we can identify two main groups. Firstly, we see projects in refineries, which are an important driver of the electrolyzer pipeline. This is green hydrogen to be put into the transportation sector, and we're going to look at the underlying business case in a bit. Secondly, we see projects in the electro-intensive industry, and this includes industries like chemistry, but also steel production, right? And here we have, in Germany at least, an upcoming regulatory design that for some industries will further the use of hydrogen by carbon contracts for difference. And in general, an important driver of all of these projects is European and national investment grants. So there's quite a diverse set of business case drivers, economic drivers for those projects. We're going to look into a few in more detail. Let's dive a bit into the subsidy structure of these projects. Next. This table shows you the major regulations impacting hydrogen production in Germany alongside the supply chain. The table lists 4 different main regulations and classifies where the main impact is. So the rows show you the main regulations, and then you see in the area of supply chain, you see a bit of a characterization in which element of the supply chain the regulation impacts mostly. So let's quickly go through it. The first regulation of main relevance is an exemption of power consumption of the electrolyzers of the EEG levy. As you can imagine, adding a few cents per kilowatt hour, maybe even to the electricity bill of an electrolyzer makes the electrolyzer lose competitiveness extremely fast. So it was important to note that in Germany there is a new law waiving EEG levy for the power consumption of an electrolyzer. This has some limitations. It's limited over the time frame, but it's also limited on full load hours of the electrolyzer. So this full exemption of EEG levy only applies for the first 5,000 full load hours, which is, from an electrolyzer point of view, from an operator point of view, a bit of a shame, because of course the operator wants to operate as well utilized as possible, so that average capital costs decrease, right? On the other hand, of course, having an electrolyzer one base load in a system that still consumes partially conventional power generation wouldn't make a whole lot of sense from an ecological point of view. The use case for that is practically all electrolyzers, and especially maybe in the energy-intensive industries. This impacts mostly the production of hydrogen. A second point, highly debated in Germany at the moment, is relevant for the transport of hydrogen, especially for grid feed-in of hydrogen. If there is some kind of hydrogen backbone for transportation, or if we even have hydrogen distributional networks, this would imply that there would need to be some kind of cost regulation, maybe, that there would be a need for grid fees for hydrogen, and all of this overall impacts the competitiveness of the hydrogen sector in general, because hydrogen as a whole can only be competitive if there is at some point a market, from our point of view at least, a market that needs some kind of transportation infrastructure. This is still highly debated, and so we will see where the incentives for hydrogen transportation and so on go to. The third mostly impacts the end use of hydrogen, specifically in the RED II relevant sector, in the transportation sector. So this is about producing hydrogen for refineries and producing hydrogen for the transportation sector in general. The RED II Delegated Act, Renewable Energy Directive II Delegated Act, is still outstanding, and it specifies under which conditions hydrogen is green and what kind of green power is necessary to source to produce green hydrogen. RED II in general says that there is a quota for renewable carbon neutral fuels in the transportation sector, and that green hydrogen can be counted towards that quota under certain conditions. And this is an important driver of refinery and transportation-based electrolyzer cases, because if you produce green hydrogen and you can count it toward those quotas, this acts as an additional revenue for deploying electrolyzers. The fourth point, most relevant for steel, cement, ammoniac in the German case, is carbon contracts for differences. There we have the first draft version of the regulation. This would act as some kind of compensation for the additional costs of an electrolyzer as a mean to decarbonize industry. And well, the compensation would be indexed versus would be made floating versus CO2 prices, so that only additional costs at the given CO2 price are compensated, and if CO2 prices are high enough, then there would be no compensation. And this is relevant for a combined case of production and end use. So we have quite a few of regulations, and this is only the most relevant ones for the business case. We have many moving pictures still, right? I think in a so fast-moving world, moving forward towards fighting climate change, we have to get used to some point that regulation will always be a bit of a moving picture, because once we're done with one, we have normally started to work on the next. I highlighted the RED II one because I want to dive into it a bit next. So this slide shows you the German example of greenhouse gas reduction targets for the transportation sector. So on the European level, RED II defines minimum share of renewable energy in the transportation sector, and Germany has implemented that on a national level and went for a greenhouse gas reduction quota instead, which is similar but not precisely the same. So what you see on the left is this greenhouse gas reduction target from 2021 to 2030, going from 6% in 2021 to 25% as a newly defined target in 2030. So this is quite an impressive development, I would say, right? Progressive development, and it speeds up over time, and is an indicator of a growing market clearly. So what does this mean? This means that carbon neutral fuels like advanced biofuels or electric vehicle fuel, but most noticeably, of course, renewable hydrogen that is put to use in the transportation sector reduces the need of transportation companies to do other things to reach their target. And if those companies actually within their company reduce their CO2 emissions in this metric more strongly than they need to, then actually can sell this as an added value via kind of a tradable quota system. And these tradable quotas, they don't have a very transparent price, but historically the price has ranged between 200 and 400 euro per ton. So again, RED II defines a quota. The German system has implemented this quota with a very ambitious trajectory. And if you produce green hydrogen in the transportation sector, for example, in refineries, you can count this toward this target or even sell the renewable element or the CO2 reduction, and this acts as an important value driver. Next. So, well, green hydrogen beyond the hype. How can we make a business case out of this? This slide shows you a bit of an illustration for that. You have a business case if costs are below revenues. So this old principle is illustrated on the left in the costs and on the right in regards to the revenues, the values. So this shows you in euro per megawatt hour cost elements of hydrogen production. So you have a lot of capex, you have some variable costs, and potentially, if you have a complete exemption, you have taxes and levies on the power demand. All of this together in a simplified calculation defines your total costs of the electrolyzer. And you can have a business case if this cost stays below your revenue elements. And what kind of revenue elements you have? Of course, you have an opportunity revenue, because if you produce green hydrogen, you have to produce less gray hydrogen. And gray hydrogen is mostly costly in regards to gas and CO2 needed for the production of green hydrogen. So this is one value driver. Then most projects have some kind of capex-based subsidy. And it's important to note that at the moment, at least, these capex-based subsidies in the calculations we have done is still necessary. And last but not least, you have an important revenue element in regards to the greenhouse gas reduction quotas or the renewable fuel quotas as of RED II. Renewable hydrogen produced can have quite a bit of a value add here, but it's important to note that this is still a bit of a moving picture when it comes to the regulatory framework. So to sum it up, what do you need to make a business case? You still need some kind of capex-based subsidy. You need, if possible, a full exemption of all taxes, levies, and so on the power demand. You need to have RED II compliant green hydrogen produced, and you need as low as possible power costs, variable costs. And here it's very important to have a well-defined power price exemption expectation and a robust PPA procurement and negotiation procedure to get the cheapest power for your hydrogen production you can get. On a side note, next, to have RED II compliant power, you need power. You need power from very specific sources, being compliant with very specific criteria. We don't know the specific criteria yet because we're still waiting for the RED II Delegated Act. Hopefully we have it by the end of the year. It's fair to say that some operators or potential operators of electrolyzers are still in limbo in regards to how the RED II criteria will look. But we have a first view on them based on the leak of the Delegated Act, which shows you that there are practically 4 criteria defining together green power that is RED II compliant. So let me very quickly go through it. Of course, the power needs to be renewable, right? Only then you can produce green hydrogen. Second, the renewable generator needs to be new in the sense that it shouldn't be commissioned more than 12 months before the electrolyzer to ensure additionality. Also, the renewable generator shouldn't have received any kind of operating or investment aid, so subsidy free. There is, and this is still a bit unclear from our reading, there is definitions in regards to the time correlation, practically saying, okay, generation and consumption should happen, if possible, on the same quarter hour. And last but not least, there is a requirement of electrolyzer and generator being, let's say, in the same bidding zone or in the same non-congested zone. So these are important criteria to have in mind, which influence what kind of power you can actually source for your electrolyzer. Next. Let me quickly sum this up. Next. Yeah. 3 main points maybe. Political framework. You have seen that there are strong strategies in place, and that we're slowly moving from strategy to more concrete policy. Industrial use of hydrogen is at the center of it, I would say, with some other areas of use still being a bit less clear. And the targeted hydrogen volumes are not only quite high, to some extent high in regards to hydrogen, but will also require terawatt hours and terawatt hours of additionally sourced green power. You have seen that power prices have demonstrated impressive increases over the last few months, which is clearly a driver for the PPA story. We see more and more interest from all off-takers, and of course not only, but it's important to build an informed price expectation and to develop a solid procurement procedure before committing to some kind of PPA to make sure that you get the best prices for your production in general or your hydrogen production specifically. If it comes to PPAs for hydrogen specifically, we have seen that the electrolyzers have many different value drivers. RED II and RED II quotas is important here. We unluckily don't have a final view on RED II Delegated Act and the criteria in there. Happy to see it soon. And then we can have a final understanding on the business cases. But I think to come from my presentation that, like, if you combine different value drivers, it's possible to make electrolyzers fly now and or soon. Thanks for your attention and looking forward to the questions.
Well, that was very exciting stuff. Thank you very much, Julius. We received quite a few questions already, but for those who are about to send us theirs, please do not hesitate. It's not too late. And I will see how we can fit them in. Now, for the first questions that we received, there was a lot of interest for your slide number 12. Maybe we can put it on the screen. And we're almost there. Yes, that's it. First of all, there was some uncertainty about what the figures mean. And second, also, what the bottom line would be on your opinion. We see very big players here on the right-hand side. To what extent do you think that PPAs can be a general means of financing renewables in the future, or will this rather be something that only addresses a small part of very big players?
Yeah, so first, what does this mean? This is the PPA pipeline realized or announced as we counted in megawatts accumulated for the different players. Right, so practically what we do, we look at press releases, right, screen them and say, if someone has announced a PPA to be signed, then we put it in. And yeah, do we see the PPA story trickling down and trickling forward maybe? Yeah. there are two elements to have in mind here, right? we do see that the PPA story is trickling down. We think the costs of signing a PPA have come down and will further come down. And we see the interest of more and more diverse and smaller off-takers entering the market, and this drives the market. At the end, the off-taking potential is a bit limiting. It's a limiting factor, and if the off-taker's interest increases, the general market size will increase. So we are pretty positive on that. It's important to note, though, that for the foreseeable future, we still think PPA will not be the only mechanism to finance renewable energies. It could happen. I mean, we can, in our power market model very easily sketch out a trajectory where almost all renewables are financed by the market. It's possible, but is it reliable? Well, let's have a look at the last few years, right? Yeah. Let's have a look at the power price drop during COVID and so on. Right? So we think it's fair to assume that we still will have like a system with two elements, some kind of subsidy and some kind of PPA, and the relative importance of it will always change a bit over time depending on where power prices are.
All right, I think a direct link to this last point. Several of you sent questions concerning the benchmark for a PPA. To what extent is it attractive today to sign a PPA if the power market is based on marginal cost, and marginal cost goes down with growing penetration of renewables? Is this something that will have an impact on the attractivity of PPAs, on your opinion?
Well, yeah, I showed this power price development forecast already, right? So we do see power market will stay as at least in its dispatching form based on marginal prices because that's efficient. Right? So the wholesale power market we for the foreseeable future see as a marginal price based mechanism. When it comes to capital cost, this is a different story. I always said we foresee that renewable auctions or subsidies will be part of the future. I personally also see a good case for capacity mechanism. I mean, in France, we already have them. I'm not a betting man, but if I was, I would say, well, in Germany, the chances are also quite good, right? Yeah. So wholesale market will stay marginal, and well, renewable energies only as the non-dispatchable providers, their value is best assessed on marginal prices. But the story is not as bad as it sounds now. With more and more flexibility and so on, we see that also marginally developed prices can keep a certain level. That is why we don't see renewable capture prices dropping below what I have seen practically. Yeah? We see with more hydrogen can set power prices if an electrolyzer has a certain willingness to pay for power. This can be a price building element and stabilize the capture prices so that they don't go too low. Nonetheless, right, with more and more renewables and more merchant renewables driven by PPAs, by merchant power prices, and dropping renewable costs, we see that, well, we often see in our models a bit of an increase, and then capture prices slowly go down a bit until they find a floor. And this, from our point, is a very reasonable development. If capture prices wouldn't stabilize at some point, this would mean that the future investment generations of renewables would earn a whole lot above their costs. And from an energy economic point of view, that shouldn't be the case as long as there's some kind of flexibility in the supply. And well, we see flexibility in the supply. I mean, in the PV sector, there's a lot of flexibility in the supply, but also in wind onshore and wind offshore now, we see that additional projects are driven by lower prices. And as long as that is the case, capture prices cannot explode. They can explode, of course, on short-term basis, but they cannot explode on the long-term basis.
That's a very good point. Thank you very much. I keep an eye on the watch, and we have a little bit more than 5 minutes left. So towards the end of your presentation, you have been talking about the impact of RED II. Even though this would be really looking into a crystal ball, but to what extent do you think taxonomy will have an impact, something you didn't mention in your presentation, on green hydrogen and the energy sector in general?
Yeah, I mean, it's interesting that we see more and more, let's say, demand side mechanism driving the market versus before, right? RED II and to some extent taxonomy are, from my point of view, a bit of a demand side mechanism. Yeah, and it's going to be interesting where those pull the market. Those have been underrated a bit historically, I would say, but we see that those mechanisms become more and more important in driving the market midterm, at least. And yeah, it's a bit of a crystal ball. I don't know specifically how taxonomy will drive the market. For RED II, I'm pretty confident that that it will be an important driver of renewable hydrogen production.
Okay. Thank you very much. And then there was one last question, or the last question that maybe we will do today. Could you comment on, we see the rise of renewables. We're talking about renewables today. Renewables are becoming more flexible and also more manageable, but there still is some uncertainty. Could you please expose a little bit on the link between PPA and the power supply contract?
Yeah.
How is this handled in the cases you have seen?
Yeah. Well, I mean, there are different ways to do it, but generally speaking, the off-taker has some kind of supply contract in place. In the cases I have seen, this is mostly a management contract in the sense that it sources power from spot markets at spot prices. And within such kind of contractual structure, it is not that difficult to phase in a PPA. Right? I mean, of course, it needs the agreement of the operator of the supply contract, and there is need for some kind of negotiation, but hasn't been, to the extent I'm aware of, hasn't been a huge problem normally. Right? I mean, story would look different probably for, let's say, mid-sized off-takers that already have some kind of fixed price position, let's say for next 1 or 2 years, right? Here, this would be a bit more difficult to, well, you have a surplus position if you also lock in a PPA for the same period of time. That doesn't really come as a surprise, but it means that you have a bit of an open position, too much power procured, which you would need to sell off to the market.
Okay. Yes, I think that's a technical issue, and we have seen in the past that topics like that could be addressed by best practice or by following best practice. We are coming to the end of this webinar. Thank you ever so much, Julius, again for this very interesting presentation and your answers during the Q&A session. And big thanks also, of course, to Celine for the technical support today. Now, before we sign off, just a few announcements. Do take a look at our coming conferences on our website. All of them will be held online for the month to come. On September 28th, this is next week's Tuesday, we will be talking about the energy transition in the city. On October 7th, we will be talking about bioenergies and the creation of value added on local level. We continue on October 12th with a webinar on rare earth metals and their impact on the energy transition. On November 2nd, permitting procedures for onshore wind projects And the one you should definitely not miss is on November 18th, the 4th Franco-German Energy Forum with French Minister for Environmental Affairs Barbara Pompili, German State Secretary for Energy Andreas Veicht, the EU Commissioner for Energy Kadri Simpson, Fatih Birol of the IEA, Laurence Tubiana from the European Climate Foundation, and many other first-class speakers. Admission is free, so make sure you go on our website and sign up and register. You can, while you're there on our website, ofat.eu or dfpev.eu, you will very soon also find today's slides and many interesting papers on topics you might find interesting for your better understanding of what's going on in the energy transition. For example, our last ones were on the energy transition's socio-economic impact on society, or the cost of renewable system integration. And this is all from my side for now. It was an exciting webinar. Thank you very much for being with us today. Please do stay safe. See you very soon. Bye-bye.